Hi everyone and welcome back. So today I'm going to be talking about 280E. Now, before we get into what 280E is, let me sort of paraphrase and just give you an idea of what 280E says. Okay, so Section 280E is a federal statute that bars any business or portion of its business engaged in trafficking a Schedule 1 or Schedule 2 controlled substance, such as cannabis, from deducting non-cost of goods sold related deductions or credits for federal tax purposes. So basically what this is saying is, because cannabis is a Schedule 1 substance and it is illegal on the federal level, businesses who traffic in such substances are not allowed to take regular operating expenses. The only thing that you can take is cost of goods sold. So when I show you this tax return versus the profit and loss statement, you are going to have a really good idea of why it's important to make sure that you are properly calculating your cost of goods sold, and that you are also making sure that you are taking advantage of every single dime that you are legally allowed to take as a cost of goods sold deduction. Because if you don't, you are absolutely leaving money on the table. You're leaving thousands and thousands of dollars on the table. Okay, so let's jump in and let me show you exactly what I am talking about. Okay, so on the left, or at least my left, is a sample 1120, which is a corporate tax return. On the right is a profit and loss statement. Now, the 1120 corporate tax return is a standalone tax return, so therefore the income and the expenses, or rather the tax, does not flow through to the shareholders of the business. The tax or everything stays right here on the 1120, and I'll show you why that makes a difference as we go through this exercise. Okay, so as you can see, the tax return, or let's start with the profit and loss statement. So the gross sales was $876,000. Cost of goods sold was $319,000. And then your gross profit is $557,000. Now, the operating expenses totaled $867,000. So for a normal business, when I say normal business, I'm talking about a business that is not a Schedule 1 or Schedule 2, or doesn't traffic in Schedule 1 or Schedule 2 substances, which is 99.9999% of businesses in the United States. They are allowed to take operating expenses, or to deduct operating expenses. So any normal business would have had a loss of $310,000 for this particular year. Therefore, they would not have been required to pay taxes because they had a loss. Now, if you look over here at the actual tax return, this is a cannabis tax return, you can see that the $557,000 is what their total income is, right? And as you can see, that's really their gross profit. And everything, all the lines for operating expenses are blank. And it says taxable income is $557,000. So that means that this business is being taxed on $557,000. So therefore they have to pay tax of $189,000. That is what their tax bill is. But if you look over here at their profit and loss statement, they didn't make a profit. They had a loss. So in all actuality, this $557,000 that the federal tax return says that the company retained in the business didn't really happen. So this is what you call phantom income, because it didn't really happen, because they actually spent all of that money on operating expenses, and they spent even more than the $557,000, which means that they have to somehow figure out a way to come up with $189,000 to pay taxes, considering that they didn't really make any money, or they actually had a loss. So this is a difference between, and this is how 280E affects your tax return on a federal level. Basically, what's happening here is you have a loss. The IRS or the feds will not allow you to recognize that loss. Instead, you're having to pay taxes on your total income. Now, the fact that this is an 1120 tax return, I guess the only, I don't even know if I want to call it a bright spot, but let's just say that one thing is, because it is a 1120 tax return, the income, or rather the tax due, stays with the corporation. Now, if you are a partnership or if you are an S corporation, this is going to look totally different. Now, the reason why it's going to look totally different is because this $557,000 that you actually did not make, you had a loss, remember, is going to be distributed to the partners and to the shareholders if you are an S corporation. So when you receive your K1 as an S corporation or as a partnership, it's going to show that you had a profit of, let's just say you have two shareholders or you have two partners. So if we take $557.34 divided by 2, that means that you and your partner, if you're a partnership, or you and the shareholders of an S corporation are going to receive a K1 saying that they had income of $278,000. That is what the paper, that's what the K1, so on paper, that's what it's going to show. Which means when you file your tax return, and you attach that K1 to your 1040 tax return, you are going to be required to pay tax on $278,000 that you never received. This is what is called phantom income. You didn't receive it because you really didn't make it, because the business actually had a loss. So that means that the partners and the shareholders are going to have to come out of pocket to pay taxes on money that they did not receive. Now, this can be extremely jolting for a person who doesn't understand how this works. So when you're taking on partners, you're bringing in shareholders, and if they don't understand how this works, this could be a problem, because if they didn't receive any actual cash, any money, and then all of a sudden they're being told that they have to pay tax on money they didn't receive, imagine how they're going to take that. So when you are setting up your structure or setting up your business, it's extremely important that you understand how this works. So if you're going to be a partnership, if you're going to be an S corporation, you really need to have a good understanding of how these pass-through entities work, because if your business is actually having a loss but showing a profit on paper, whoever the partners of the partnership and the shareholders of the S corporation are going to have to pay taxes. So you want to make sure your investors are very clear and that they understand how this works. Okay. So, and keep in mind, I am not your accountant, so I am not giving you tax advice. I'm not advising you on how to set up your business structure, but I would suggest that you speak with your accountant and you speak with your attorney to figure out what's the best structure for you, because your attorney is going to help you when it comes to the legalities of the structure and how the structure is going to affect you from a legal and a liability standpoint, whereas we, the accountants, are going to tell you how it's going to affect you from a tax perspective. Now, sometimes we clash a little bit with the attorney, but if you have a good attorney and a good accountant that put their heads together, they can definitely come up with a situation that is definitely advantageous to you, the business owner. Okay, so what's the moral of the story? The moral of the story is you need to understand that because of 280E, it's important that, number one, you budget. You pay attention to your cash flow, because you're going to have to possibly pay taxes on money that you actually don't have. So you have to pay attention to your cash flow to make sure that you're able to cover all of these expenses, number one. Number two, you want to make sure you have a budget. You want to make sure that you budget and that you project all of these. In other words, don't wait to the end of the year to now figure out that, oh my goodness, I owe this money and I don't have it. So you want to make sure that you budget from the beginning of the year, and you create a budget that is going to possibly reflect what could happen at tax time. For example, owing on money you didn't actually make. And number three, you want to make sure that as you bring on investors, as you bring on partners, that they have a pretty good understanding of how this works. Because people can get really excited about, oh, I'm going to invest in a cannabis business, I'm going to make all this money, and they may not have a true understanding of how things work if they are a partner in a partnership or if they are a shareholder in a corporation. They may not understand that at least the first couple of years, the business may not actually have, may not make a profit. Even though on paper it says they did, in all actuality, they may not have made a profit, and therefore they're going to have to pay taxes on money that they didn't receive. Okay, so that's the moral of the story. And hopefully you enjoyed this content, and don't forget to subscribe and also like my channel. And if you have any questions, please feel free to reach out to me. My link is in the description. You can reach out to me and set up a consultation. All right? Thanks, and I'll see you next time.